So we are going to be having a bunch of people popping into the webinar here. I think it takes maybe another minute or so before everybody is logged in. So we'll kind of give it a little bit of time to let you guys all get situated. Yeah. Jake, tell me this. What have you been reading lately? What, it can be financial, non-financial. Tell me, like, what is it that you have been finding interesting? How you've been filling that head?
Yeah, well, I guess besides children's books to put kids to bed, I got 3 little kiddos at home.
Yeah,
But no, I guess some of the stuff I've been reading recently, I always find stuff just around, I'll say science in general, interesting. I just read Bill Bryson's A Short History of Nearly Everything, which is a good read, just kind of the history of the universe and the history of the earth and a lot of the things you know, but good to go back and refresh on. On the investing side, I just read Trillions, and I don't know if anybody on the call has read it. If you haven't, I'd highly recommend it. Sort of the history of modern finance, index funds, ETFs, where we've gotten to, really good. And then maybe a guilty pleasure, I read The Bad Blood, which is the Elizabeth Holmes story, which that's that one's mind-boggling. I mean, you look at the people on her board and the sort of how she pulled the wool over everybody's eyes. That one blew my mind.
Yeah. So, did you watch the HBO documentary to that? Like, does it just go deeper? Is it better? Is it, I mean, a total difference? So I definitely recommend it.
I haven't. So I had heard about the documentary and I wanted to read the book, and I'll go back and check it out. But from what I've heard, whether it's the documentary or the book, it is one of those where you're just like, how did this happen? Like, how did she fool so many people?
That's nuts.
Yeah.
Well, it looks like we've got everybody in at least for a little bit. I know we've got a couple hundred attendees or registrants who are coming from all over the nation. It was fun to see the breadth of people who are registering for tonight's webinar. I want to thank you for coming. My name is Colin Wiens. I am the president of Larson Financial Group. And I am honored to have Jake DeKinder here from Dimensional Fund Advisors. And Dimensional has been a partner of ours with Investment Solutions for years and years. And with all of the craziness that's been going on in the market, we thought it'd be worthwhile for clients and not clients to be able to spend a little bit of time with us tonight. Just kind of hearing about what is the academic approach and systematic investing philosophy that Dimensional takes as they're looking at some of this stuff, whether it be inflation or recent market volatility. And so Jake, as head of client communications, is really the guy that is focused on how do we get the message out of that academic approach to both advisors and investors. And so again, super glad to have him here. He's a CFA, which is really the board certification for investment gurus. You can think about that. And so I'm glad to have him. I represent, like I said, Larson Financial Group. Some of you guys are clients, some of you not clients. We've got financial planners, financial advisors, about 40 of them spread across the nation. We have clients in every state of the nation, got about 4,000 or 5,000 clients there spread all across. And so many of you guys are able to join tonight. And we really help work with clients from all stages of their life, whether it be a 35-year-old radiologist or a 75-year-old retiree. And so we're going to be trying to bridge that gap tonight, talking about how does the market performance and inflation and cryptos and all sorts of other things impact that spectrum. And so we're going to do our best to try to get to your questions that you guys have submitted. And we'll do our very best time. We're going to go right up until the top of the hour. We'll try to hold a little bit of time there, maybe for some other Q&A. But let's get this started off. So as you guys all saw in the email, we are going to be talking about market performance to start out. And so, Jake, I don't normally, despite being a financial advisor, and we'll probably unpack this a little bit more, but I don't normally go in and check my portfolio too often. But my personal portfolio, as I checked it in preparation for today, year to date, it's down 4 to 5%. Since the beginning of the year, we've had more than 20 days that have been negative, and as many people have seen, there's probably been more than like 10, 11 days that have been more than a whole percent negative when it comes to the S&P 500. So it's been in the news a ton. There was a day where it was almost 2.5% down. what gives, and what should we be doing?
Yeah, no, I think that's a good place to start the conversation. And at a high level, I look at it and say, oh, well, then markets are working exactly the way that they should. And what I mean by that is, look, when you have a lot of information that's coming out, positive or negative, look, if you didn't see big movements in the market on a given day, or you didn't see kind of the ups and downs, you really have to ask what's going on, right? I mean, that's what markets do. They process information and they go up and down based on it. And so if I saw, we'll get to inflation. If I saw inflation numbers coming out, I looked at the geopolitical landscape and some of the stuff that's going on in Russia, and you didn't see markets go up and down, then I'd be like, okay, now we've got a real issue. But this is what they do. And so a couple of points there. So over, this year to date, you said you got about 20 days that have been down, 30, 35 trading days in the market. I'd have to go look at the exact number. On any given day, quite frankly, it's kind of a flip of a coin whether the market's going to be up or down. Now, listen, as that time period extends, right, as I go from a day to a month to a quarter to a year to 5 years to 10 years, the probability of seeing positive returns goes up. And that's what the data supports. But if you get caught up in watching the day-to-day, I mean, you're just going to stress yourself out. Now, in terms of the larger market movements of 1% here or there, what tends to happen, and you don't have to get into details of it, but when you see a little bit of volatility, it tends to be followed by some more volatility. This is just what happens through time. You get some smooth patches, and then you get some more volatile patches, and it spikes up a little bit, and then it falls back down. So look, it's never pleasant to watch your portfolio go down. None of us want that, but there's nothing that we've seen here to start the year that is somehow abnormal from what we've seen in decades of markets all over the world. And I guess I'll give you a little analogy. The way that I think about it is, imagine you were walking up a staircase and you were doing a yo-yo up and down. If you focus on the yo-yo going up and down, you're really going to stress yourself out. But what tends to happen? Well, the staircase goes up and to the right over the time. And that's what I say with markets, right? Over the time, they tend to go up and to the right if you looked at a graph. So just remember, if you're focusing on that yo-yo going up and down every single day, you're going to add a lot of unnecessary stress where over time, what do markets do? They tend to go up and to the right. Staircase goes up and to the right, even though in the short term, it kind of goes up and down.
So one of the things that I found personally, again, not having to look at the portfolio too much certainly helps, but what makes that really freaking hard for me, and for many people as I talk to clients, is you've got the alerts popping up on your phone. You've got you turn on the TV and people are talking about things are crazy. And as I look back, last time my portfolio was at this current value that it is today, it was 3 months ago. And I can tell you 3 months ago, we're at the tail end of a 20% increase. I thought things were doing amazing. I wasn't mad that my portfolio was worth that much. And so even if you go back and include this last drop, it's still a 10% annualized. It's still pretty good. But the media, as what's being put in my face, and these folks the TV personalities or the financial media, they get paid for eyeballs and clicks, and not so that way you can hit your goals, right? And so I think that's one piece that sometimes is so hard to avoid because it's everywhere and it is drawing your attention. There's an active approach to get you to be focusing on the fact that it was down 2.5%, when realistically for many of our clients that means not a whole heck of a lot. Like you said, focus on the staircase rather than just the yo-yo for each step.
Yeah, I mean, I think, look, you bring up some great points there. I mean, the way that you thought about that of, hey, here's the value of my portfolio today, and it's at the exact same level than it was 3 months ago or 6 months ago or whatever. You know what? I felt great back then. And now, just because I've had this recent drop, I feel horrible about the level. I mean, there's this recency bias about how we feel. And again, you gotta try to take a step back. And again, like you said, I got a long-term goal that's out there. I put together a game plan. I work with my advisor. I put together a long-term game plan. And as long as you're on track for that, you try not to stress too much about the recent piece of it. And your comments about the media are spot on. And we've said this for years, right? I mean, what gets eyeballs on any type of media, right? It's, if it bleeds, it leads. They lead with the bad news, or many times they'll lead with the hype and people get overexcited. And then you get the FOMO and I'm missing out on this and I'm missing out on that. Just remember the motivations of any type of business that's out there. The financial media, what's their motivation? Their motivation is to sell ads. I mean, at the end of the day, like that's what they want to do. They want to make more revenue by keeping eyeballs on it and selling ads. If I came on the financial press every single day and said, hey, listen, take a long-term approach. Don't worry about the fluctuations day to day. And you know what? When Apple's up, you have that in a diversified portfolio. And when Facebook or Meta's down, you have that too. But over the long term, things are going to be fine and stay diversified. I mean, after a week, I'd be fired. I would never be asked to come back on a financial news station. So you just sort of remember what the motivation of all of these different players are and what's the motivation of an advisor to help you tune that stuff out, to put together the game plan, to keep you on track for your goals, to be objective about your money. So it's tough. I mean, look, like you said, you get these alerts that are popping up all the time, and it's hard not to pay attention to this stuff. But you know, what's going to give you the best chance of success? Well, probably not making an emotional decision based on some news story you read about what you should do with what's going on in the markets.
I tell you, the best life hack that I've gotten over the last couple of years is, and everyone's heard it probably by this point, is just turn off the notifications on your phone, right? And I don't mean for like, you want to be able to answer your wife's phone call, but turn off like the news notifications or your financial apps notifications, because like they know. I was talking to an app designer recently, and he was like, no, our goal is to keep you in there as much as possible. I get embarrassed when I look at those the screen time reports that tell you like how many times you picked up your phone. It's embarrassing. If you haven't looked at that, go look at that, and I think that'll force you, or at least encourage you, to go turn off those notifications. I want to pick up what you said about the advisor piece real quick though, because ultimately, like, look, if your advisor is freaking out because you're down 5%, 4.5% to 5% in your portfolio like you are right now, then something is wrong. The reality is by working with somebody, they are already anticipating this. This has already been planned for. Like, you should have 10% loss pressure tests, 20% loss. Like, that should be stress tested enough to say, look, remember why we're saving money in the first place? We're saving money for a goal, to be able to pay for your grandkids' college, to be able to save for retirement, stop working at some point, to be able to get a beach house, whatever it is. Like, that's a goal. And if you're doing that right, you should have the pressure test to know, like, look, I'm still 95% on track even with this. That really doesn't impact it. That's like, why are we saving? Keep the goal in mind, and then we can come back to, okay, breathe a little bit, maybe turn off your notifications, and then move on from there.
Yep. Completely. You know, and along these lines, so we're a data shop here at Dimension. I like my numbers at times and to show you some stuff, but I'll give you a couple of data points around this idea of, recent market volatility. What have we seen historically? If it's down a little bit, what should I expect? Hopefully some of these numbers will give you some perspective as we think long-term. I'll show you a couple of charts here. These are kind of interesting. So you take a look at this, right? And what you're looking at here is to say, okay, I see what the calendar year returns were for, this is the Russell 3000. Just think of this as all the U.S. stocks that are out there. But you can see the bar, and that's what it did in a given calendar year. Now look at these, what we call sort of these whiskers. What's the largest gain for the year, and what's the largest decline for the year? And in every single year, you have these relatively large declines and relatively large gains during the course of the year. So look, okay, we're down 4, 5, 6%. Yep, I've seen that historically. If we were up 10%, yep, I've seen that historically. We were down 12, 14. Like, we've seen this over and over. And so when you get these big movements up and down, it doesn't mean you're necessarily going to have a down year in the market. So just sort of take a deep breath. Even if from here, look, we built the plan so that we could weather a 10% down or a 20% down. Great. We have a plan for it. And by the way, we've seen it historically, and that has no bearing on what the returns for the year might be. I'll give you a couple other data points here. And I find these very interesting because to me, they kind of tie together the two emotions of fear and greed, which I think a lot of investors feel. You think about this. Let's imagine that the market's just going up. And this story has been out there a lot around this concept of all-time highs and what's going to happen and should we stay invested. But let's just imagine that we hit these sort of all-time highs here. And when we hit that and people say, well, should I stay invested in the market? I'm a little bit concerned of, should I keep my money invested? Should I put more money to work? Implicitly, what they're saying is that this is what I'm concerned about. It's going to drop to some level, and I'm going to lose money the second I put money to work in the market. Then the question is, Okay, so when do we invest? What's the signal we're looking for? And that's, man, I'll tell you what, I think so many investment questions are just, as I say, they're kind of market timing questions in disguise. And I don't mean that negatively about investors. I think everybody's looking for a signal so that I can get the good and avoid the bad. And you find all different signals that are out there, whether it be GDP or unemployment or inflation or valuation ratios or whatever. But, they're concerned at all of these levels that it's going to keep going down. And let's imagine here that it's not you're at an all-time high. Here you're down 20%, right? And that can be painful to go through. But look, the all-time high and the down 20% of all of that stuff's in the past. The real question for us is looking forward as investors, what should we expect to earn? And if you look out there and say, okay, listen, every time I hit a all-time high, and I'm going to look out 1 year, 3 years, and 5 years, on average, how do I do? Here's your 1 year number, 13.9% on average. Doesn't mean every time it's going to happen, but those numbers look pretty good to me. 3 years out, 10.5. And by the way, that's an annualized number over 3 years. 5 years out, 9.9%. Now, what about the down 20%? Because people get concerned about that when we see big drops. I look out 1 year, I look out 3 years, I look out 5 years. What do those numbers look like? Okay, I'll give you some of those. 11.6 on a 1 year, 9.9 on a 3 year, and 9.6 on a 5 year. And if you think about what's the long-term return of the market, I don't know, right around 10%. So I look at this number and I look at this number. Gee, that looks pretty darn close to that long-term return of the market. So, you sort of say whether I'm at an all-time high or I'm down 10% or down 20% or whatever it is, I look out a little bit and the numbers look pretty darn good to me. And what's the alternative? Cash? I don't know, man. That's a tough game to play. So it's hard to manage through it. Again, huge value of the advisor. But just remember, the data says whether I'm at an all-time high or down 10 or down 20%, there's nothing to indicate that somehow I should change up my game plan.
So the heart in picking up from your kind of graph, I'll have conversations often with clients. And again, understanding that I am just as human as much as anybody else. And I'm going to get that emotion. When things are bad, like it's like having your hand over a candle. Like when you feel pain, you want to pull it away. And so I understand it. But let's say that we know we can see the future. And let's just take that for a fact. We know that it's going to go down. Not only do we need to know that it is going to go down, let's assume we do know that, but we also have to know when it's going to go down. So that's when we're going to sell right before that, right? That would be ideal. And then when is at the bottom before we're going to come right back up? Because if you can't do that, like if you can't time that well, which not only do you need to know the direction it's going to go, but you need to know when it's going to have that happen, then it's really hard not to lose money. Again, that is just the data shows, again, as you guys have well documented, that trying to do that, trying to time it, even if you know the direction that it's going to go in the short term, is just kind of a loser's game. People who try to do that on average are not able to accomplish it and end up spending more money in taxes, more money in fees in order to try to do that.
And you're exactly right? I mean, what are you trying to do? You have to make two correct decisions over and over again. When to get out, when to get back in. And again, everybody's looking for that signal that tells me exactly when to do that. And listen, if it was that easy, I can promise you, people would have figured it out. We got a lot of smart people here at Dimensional. We work with a lot of smart advisors. I can tell you right now, they would have figured that out by now because everybody's been playing this game for practically 100 years of when to be in the market and when to be out of the market. And the problem is that these runs in the market, they pop quickly. And I relate it back to like my kids. Again, I got 3 kiddos, and Barkley, our oldest, plays flag football. And for those of you that are tuning in and you got kids and stuff, you spend your Saturdays running people around and going to these sporting events and doing all of those things. And you sit out there all day, and maybe the kid needs a granola bar or a bottle of water or whatnot. And this is a true story. Barkley's out there playing, needs water from the car, go to the car to get it. And what happens? That's when Barkley scores the touchdown, right? I mean, you're gone for a minute, and that's when he scores the touchdown, or that's when they score the soccer goal. And markets are the same way, man. They pop real fast, and you have absolutely no clue that it's coming, and it can be painful if you miss it. I'll give you a couple of stats here. Check this one out. This will really drive home the point here. So looking at that Russell 3000, I'm going to look back over the last 25 years or so, and take a look at this. Over the total period, you would have gotten about that 9.7% return. What do you see? About the long-term return of the market, right around 10%. Let's say you missed the best week. And I love this analysis. And here's the reason I like it is that this is not missing the best 5 individual days over the last 100 years. Nobody is that unlucky with investing. This is missing the best 5 consecutive trading days. So missing the best week. What happens? Goes down to 8.9. And here's what I want to make this very real, because when I tell people, hey, 9.7 versus 8.9, they clearly know 8's less than 9. Let's put some dollars to this, right? Let's imagine that you would have had $1 million invested. You went from having $10 million to having $8 million during that time period by missing just the best week. That's what we're talking about. It can pop quickly. Take a look at the best month, the best 3 months, the best 6 months. You look at something like this best 3 months. Just 3 months of being out of the market over this entire 25-year period, you went from $10 million to $7 million. That changes the way that people retire. And I'll make it very real for you. Let's put some dates to this, okay? Because sometimes you see this analysis and it's almost like theoretical from the 20s or from the 30s. Look at these dates. I see some 2020s on here. People just lived through this. So you were out of the market for a very brief period of time over the last couple of years, and you just went from having $10 million to having $7 million. That is a dramatic difference in what you can do when you retire. So they pop quickly, and man, you got to stay engaged if you want to capture the long-term return of markets.
The closest thing that I found to being able to not predict, but take advantage, like everybody wants to buy low, sell high. And the closest thing to being able to do that is knowing that these fluctuations will happen, but being able to have as much of a diverse portfolio that as some things are going down, you're just buying more of those. And again, you don't know. They'll maybe continue to go down and you'll be kicking yourself if you didn't wait. But if you have a consistent process that says as some things are going down, then you're buying them. And as some things are going up, you're selling them. That's the closest thing that we're going to have to be able to take advantage of buying low, selling high. And again, it may continue that way for a long period of time where it really hurts because you're continuing to buy as stuff goes down more and more. But that is going to be the best process that we've seen to have somebody, whether it's yourself or an advisor or whatever it is, a consistent process for that rebalancing is really what's going to take what you're saying and say, look, I'm not going to try to time things. I'm not going to try to get in and get out, as all of us felt like we probably wanted to back in 2020. But instead saying, I've got a consistent process that as things go down, I'm going to keep buying them. And that kept going for 30, 35% down. And you were really glad at the end of that year that you did that if you had a process built to do that.
Well, and you're right about that. I mean, I love the fact you use the term process because you want to try to pull the emotions out of it as much as possible. Again, it's about putting a game plan in place, being very systematic about it, whether it be on the financial planning side or on the investment side, whatever it may be. And look, with investing, there's no guarantees. That's just not the way it works. All you're doing is making decisions every single day that put the odds in your favor. That's what good advisors do. That's what we do here at Dimensional. I mean, literally, the way we manage money is we just make a series of decisions every single day that, based on a ton of research, we believe puts the odds in your favor of capturing market returns in the best way possible. Beyond a guarantee, that is all that you can do. Make decisions that put the odds in your favor.
So I want to pivot a little bit because I'm seeing these numbers and we're seeing 10% rate of return on average that we're talking about. But so many of my clients, when we're looking at a 10-year time period, they may not be seeing a 10% rate of return, right? So they're seeing 6, 7, 8% rate of return depending on their individual portfolio, but that they're hearing you talk about 10%. They're hearing their colleagues talking about being in like these FANG stocks, Facebook, Apple, Amazon, Netflix, Google, like they're talking about all of this. And those guys are getting 20%, 25, like 30% rate of return. So bridge that gap for me between what people experience and what we see out there in conversations or what we're even having a conversation about now.
Yeah, well, I guess there's a couple of parts of that. I mean, one, just anytime you're talking to somebody about their investments, just remember they're rarely giving you the full story. They're telling you about the winners and not telling you about the losers. So, but we can come back to that point there. And look, there's always going to be stocks that do well. There's always going to be sectors that do well. And by the way, in a diversified portfolio, you do own that. You just own it in a more intelligent manner. But this idea that somehow these there's these stocks that dominate the market and they're always going to be the dominant stocks. And I have to own that to have a good investment experience. It's just not the case. And I'll give you a simple, well, this first slide's not simple, but the takeaway I think will be clear. So what you're looking at here is to say, listen, what are those big stocks that are out there? And you can look by decade here. I mean, you can go back to the 1930s here and you can see AT&T and you can see, do they carry through? And yeah, there's certain stocks that carry through and they remain some of those big stocks that are out there. But I mean, almost every single decade that you look at on this chart, what you see is you get new entrants into the markets here. And certainly recently, it's no different. We have new big stocks that have been the dominant ones that are out there. And again, remember, you own those in a diversified portfolio. So deep breath on that. But look, back rear view mirror investing of what has done well, that's really not that helpful. And by the way, that's super easy. I can always tell you after the fact what did well. What matters for us as investors is looking forward, what should we expect from our investments? And so what we did is to say, hey, listen, if you look at these big stocks that are out there, how have they done after they become these big dominant stocks? And this chart really drives it home. What you're looking at here, this is in the 10 years, the 5 years, and the 3 years leading up to becoming one of those big stocks that are out there. And these are their returns relative to the market. Now, by definition, how would you become a big stock? Well, you would have strong returns relative to the market. So, I mean, you would have to see the chart work out that way. Otherwise, they wouldn't become the biggest stocks. But again, that's not what matters for us because here, we're standing here today, right? Looking forward, what should we expect? Well, looking out with these big dominant stocks, here's what you see relative to the market on 3 years, on 5 years, and on 10 years. You see returns right in line with market returns. And it's interesting if you look last year in 2021, if you take and you look at the top 10 stocks in aggregate, or if you even just look at the FANG stocks and say how they do in 2021, they had about a 27, 28% return. Okay, what did the S&P do? I don't know, right around about 27%. So they were in line with market return. So what I always say to that is, again, you can always identify the great performers after the fact. What should you expect from them going forward? And what we've seen historically is that these stocks that have had great runs, they tend to perform in line with the market going forward. Now, some may still have great runs. We might see Alphabet, and they just came out with quarterly earnings. Great. It was up big. All right. Well, what about Meta? They got pummeled in terms of what their returns were. So again, what's the best way to accomplish your goals and invest in the equity markets? You probably want to stay diversified. You want to take a long-term approach and be careful chasing performance. Man, chasing performance that's a slippery slope.
So, okay, vulnerability time. We try to live out, eat your own cooking is what we say. And so what I tell clients and what I even practice is 95% of your portfolio, if you want to go play with some other things, 95% of your portfolio needs to be in this exact philosophy that we're talking about. 5%, you want to take it to Hard Rock Casino, you want to go day trade, whatever you want to do. If that scratches an itch to prevent you from then jeopardizing the other 95%, then we're comfortable with. And so what I am just as guilty as anybody else for is trying to be a fad finder, right? Like there's something fun and sexy about that. We want to have like this great story that you tell at a cocktail party. And so not only are humans kind of fad finders, but we like want to associate with winners. Like we all do. This is social. This is whatever it is. Not only that, do we want to like associate with the people who are associating with winners? Like it like even kind of goes downstream. And so when the Rivian stock came out, like I didn't get in on the IPO, but I bought it not too long after, maybe like $100. It had dropped down 15%. I was like, oh, it's $100. It was 170 at one point. It's got to be totally on sale. And I'm like, you know what? Let's just put a little bit of money on there. Right now, it's down 35% because I'm thinking, you know what? Tesla was up so much, 10,000%. Like it's just crazy growth. Rivian is just like the new Tesla, right? And so notwithstanding, who knows what's going to happen over the next 20 years. It could be out of business. It could make a ton of money. That's not really the point. I think it's a fun company, but that I am just as much to say, not only do I want to associate with the winners, but I'm going to associate with like not a Tesla, but somebody who looks like a winner because I think that's fun. And again, just as bad as anyone. And the idea, and this is what we tell our clients, again, you want to go do that because it helps you scratch an itch, then that's fine. Because we've built into your plan that the 95% of your portfolio that is being taken care of, that you can depend on. And that's really goals-based planning when it mixes with investments. And so again, there's no data to assume that just because, Tesla did well, Rivian will do well, or whatever it is, Bitcoin to this, any other crypto, And so that's what we try to teach our clients and then also kind of live out ourselves. But it can be hard. Again, we're all guilty of that at some point.
We're all, I mean, look, we're all human. I mean, that you just nailed one of the biggest advantages of working with an advisor is be objective about your money and be able to stick to the game plan. Look, we're all human, right? I mean, that's just the reality of it. And we have the, it's FOMO and I want to go to the cocktail party. I want to be able to talk about that. And look, I might follow the markets or I got an opinion about a certain company and all that. And again, you take 3-5% of your wealth and do that. And it doesn't affect your long-term goals one bit. Okay, that's fine. That's behavioral management. And that's totally fine. I mean, look, we all have that. But you just got to make sure that it doesn't affect your long-term plan. It's interesting, the opinion on an individual stock, because we've all been there before. We all sort of have these theories on why different parts of the market might do well at time or a certain stock might do well. And if you follow it to an extent and you're a reasonably intelligent individual, you can come up with a very plausible story on why things should do well. Just remember, there's millions of other investors that have formed that exact same story, and half of them think it's a buy and half of them think it's a sell. So guess what? It's probably priced reasonably well. I'll tell you a quick story. This is great. This is years ago. I'm flying on a plane, and this guy next to me says, what do you do? And tell him I'm in the investment management business and all of that. And of course, he's like, what stocks do you like? What markets do you like? He said, you know what I do? He said, I buy Igloo, this, the cooler company. He's like, I buy it in the spring leading up to the summer because people need coolers. And then I sell it in the fall because that's when it gets cold. I really had to bite my lip because I was like, do you think you're the only person that knows it gets warm in the summer and gets cold in the winter? And then the best part about that story is I actually went and looked it up and Igloo wasn't even a publicly traded company. So that was a good one for me. That one I put in my back pocket. I was like, that's a good story. I like that one.
Yeah, I like that. So, okay, we've bridged the gap with the super producers who have done just this crazy returns in the past, and to say that there's no indication that's going to do that in the future. What about the side that is on the more conservative piece? We're talking about goals-based planning, and the reason why somebody gets, again, 8% return or 6% or 7%, again, everybody's situation is different, and we're all kind of playing different games to accomplish different goals, but why don't we just put it all in stocks, get that 9.9% rate of return? Tell me a little bit about that.
Yeah, I mean, look, you can show long-term averages for these stocks, but you don't get that every single year. You don't get it every single day. You don't get it every single year. And there's plenty of periods where stocks can have negative returns. I mean, go back to 2000 through 2009. S&P's got a negative return, negative annualized return, obviously then a negative total return over a 10-year period. So you just have to be prepared for it. But again, it comes back. So we'll talk about the stock piece of it first. And just remember why you earn a return at all. You earn a return for bearing uncertainty. It's like if you knew every single year that stocks were going to make a 10% return, or you knew every single year value was going to do better than growth, or small versus large, or international versus U.S., there'd be no uncertainty related to that. You would not earn a higher return. That's just not the way it works. You get a return as an investor for bearing uncertainty. That uncertainty comes in many different forms. It's not just volatility. Sometimes it's your real returns don't conform to your expectations. Every single year, we expect stocks to do better than cash. There are plenty of periods where stocks do not do better than cash. That's part of the deal. Now, you don't have to be 100% in stocks, right? That's where you start saying, I can work in some other asset classes. If I say, hey, I want to get 10% up, but I can't take more than a, 5, 10, 15% down over some period, you name it. Great. That's where we can work and say, let's work in some other types of investments that have different risk return profiles that ultimately can help keep us on track for your goals. But again, I always try to really drive home this point with investors of why do you get a return? You bear uncertainty in some form.
I like it. So let's then pivot into we're talking about stocks, we're talking about cash, and then with bonds, with recent discussions on interest rates, with recent discussions on inflation. Tell me a little bit about how people, and maybe we'll be focusing on those who are maybe on more fixed income, people who are getting closer to retirement. Again, for most clients who are 30 years away from retirement, they're not thinking too much about inflation this year, maybe too much about potentially heavy bond exposure. But for people who are closer to retirement, already in retirement, they're thinking, man, this doesn't feel right. And so tell me a little bit about how we should be thinking about bonds, how we should be thinking about inflation, specific for people who are in that last half, closer to retirement or in retirement.
Yeah, so a couple of things here. I'll start with a high-level comment, a couple high-level comments about inflation, which is one, just remember that some inflation is good. I mean, we set a positive inflation target, two and change. We want to see positive, relatively stable, relatively low inflation. Look, it helps businesses plan. It helps investors plan for it. So just remember that as soon as you hear the word inflation, don't just coil back in fear, because what's the alternative? Extended periods of deflation? That's not going to be good for economic growth. So that's one thing to remember. The second thing I like to say is, listen, we've seen these year over year numbers be high and largest than we've seen in an extended period of time. But rather than a 1 year number, could I look just a little bit further? Could I look at over the next 5 years and say, what exactly is the market pricing in over the next 5 years for inflation? And by the way, you can pull this data. I'll show you a chart here. It looks complicated. It's not that complicated. All you're looking at here is to say, what's the difference between giving the government money for a 5-year regular treasury bond or giving the government money for a 5-year bond that has inflation protection on it? And by the way, that's called a TIP. So you have instruments that can help protect against unexpected inflation. And if you just look at the difference between there, think about this as, what's the market telling me we think inflation is going to be over the next 5 years? And you start to look here. Here's the 2 and the 3% over here. And you kind of look at where we're at right there. And a couple of weeks ago, I looked, it was at 2.75. So, look, deep breath on, yes, year over year numbers are high. Don't get me wrong. But over the next 5 years or so, what's the market telling me? I don't know. Inflation right in line with kind of what we've seen over the last decade, maybe slightly higher, but nothing where we need to, be dramatically concerned. And by the way, look back at this 2008, 2009 time period, because this was another period where we said, oh my gosh, it's going to be absolutely runaway inflation. We don't know how we're going to manage it. Now, granted, your 1 year numbers didn't look exactly the same as they did, but what was the market telling you back then? I don't know, about 2 to 3% inflation. What do we get over the next decade? About 1.5%, 2% inflation. So I'm not here to tell you that it's not going to continue to be high. I have absolutely no clue what's going to happen with inflation, but I do like to take a step back and say, what is the market, which is made up, by the way, of very sophisticated investors that are pricing in all of this information about inflation? What's it look like over the next 5 years? And I guess the last point, I'll make there is that regardless if inflation is high or it's medium or it's low, we have the tools to accomplish our objectives, which I always find very comforting. I love to do projects around the house. And when I walk out to my tool bench and I know the exact tool I need to accomplish a project, I literally get a smile on my face. And so when I look at inflation, I say it's another piece of uncertainty that we all deal with as investors. But if I happen to be somebody who is closer to retirement, who is in retirement, and some of my more immediate needs are sensitive to inflation, I have the tools I need to accomplish that goal and make sure that I can still stay on track for what I'm trying to do.
Yeah, that's right. And so when we're planning for a client, when I'm building out a financial plan for a client, and I don't always get to this level of detail with every client because some people want to be very high level, some people want to get very deep. But when we're building out a plan with the client, what they may or may not know is that we're actually planning on a 3.8% long-term inflation rate. Like, we have some buffer in there, right? Like, even if you're right, long-term is 2.75 to 3.25, we have still buffer in there. And so again, this doesn't feel good. I know when you go to the gas and you see the increase, or when you go to the grocery store and a $30 bill now feels like it's $70. It's probably not the case, but it feels that way for sure, that we are planning for that, right? We are planning for long-term 3.8%. Looking back, like you said, averages 1.8, 1.9 for the last decade. And so again, this 6-7% that we've experienced in the last year, it doesn't feel well, but this is being planned for. If you've planned appropriately, then we shouldn't be worrying about, again, whether this has been pressure tested. This should be part of, why are we saving money in the long term? What are our goals? And is this actually going to be saved as part of our plan? And you should.
Well, and let's also remember that stocks and bonds have held up just fine through periods of high inflation. And I like to say the high inflation because, look, when inflation is relatively low and stable, nobody asks questions about inflation, right? That's not the question that you get. It's when it's high. And you can actually say, look, I know the stuff that's done just fine through high inflationary periods. In fact, on this chart right here, that's what you're looking at. So this is saying, look, let's look over these last practically 100 years that we've got. And I just want to look at years above median inflation. So think of these as the high inflation years, right? And how did different types of investments do through that period? And you can see here treasury bills. Think about the short-term loans to the government. I think about it relatively like almost like cash, right? Negative return, not a negative absolute return. This is accounting for inflation. So when you see that number, this is saying T-bills failed to keep pace with inflation in high inflation years. Okay, got that. How about bonds? Okay, government bonds, corporate bonds have done pretty well. I hear this argument all the time of, oh, inflation is going to be this, and I'm going to get absolutely crushed on my bond investments. I'm not here to tell you that they just did so well in high inflation years. But again, these are not absolute returns. This is above and beyond inflation. This is above and beyond inflation. This would have helped keep you on track for your goals. What about stocks in general? A little bit better. What about some subset of stocks here? Large growth and small value, we can see that. So I like to show this as just hey, even in periods of high inflation, we know the tools we need to accomplish those objectives. And it's helpful to me to say this, what are you trying to do with inflation, right? Are you trying to perfectly hedge whatever may come with inflation? Great, we have tools we can do that. Are you trying to outpace inflation over some period of time? Great, I know the tools that I have to accomplish that objective. And it all comes back to, and Colin, you said this, we built it into the plan, right? I mean, do we want to see extended periods of 6, 7, 8% inflation? Probably not. I mean, we'll have to deal with it at some point. But regardless, we've built this into the plan and we've got the tools to help keep you on track for your goals.
So we talked a little bit about people who are later in towards retirement. They're largely heavier into bonds, perhaps. And you kind of pointed out that even real returns, we're still seeing some potential gains on average in those high inflation years. So for our retirees, what we're thinking is, look, doesn't feel good. I know that, again, whenever you go and you fill up with gas, you're going to be paying more than you thought you were or than you were last year. So we've talked a little bit about that subset of group. Talk to me about what sort of thoughts should accumulators who are still earlier on their career and saving, what should they be thinking about inflation? Is there anything that they should be building into their plan?
I think that my opinion there is like, look, if you've built inflation expectations into any type of financial plan and you've got your, whether it's a 5-year, a 10-year, 15, 20-year inflation expectation that's built into it, you've started to account for that. You know that earlier on in your life, you're probably going to have more weight in stocks, all else equal. We know there's a lot of factors that play into that. And we just showed that over the long term in high inflation years, stocks do really well at outpacing inflation. So there's nothing, I mean, I'm in my early to mid 40s right here. Do I want to see inflation of 7, 8%? Do I want to see? No, probably not. But there's nothing that I'm seeing right now that gives me any concern over the long term that somehow these various asset classes that I'm invested in are somehow going to be, dramatically affected by what we're seeing currently with inflation. And also, by the way, people like to say, well, inflation's going to do X and the stock market's going to do Y. Well, again, is that a signal? Yeah, it's a signal you're looking for, and it's just not that clean. Sometimes inflation is high and you get a great return in stocks. Sometimes inflation is high and you don't. Sometimes it's low, and I mean, you guys get it, right? So over any given year, if in 2022 inflation remains high and you get a negative return in your stock portfolio, please do not come back and say, Jake told me that I was going to get a good return this year in the stock market, right? That's not what we're saying. We're saying, on average, having this approach, this is what we've seen over the long term. And what does it come back to? It's a decision that puts the odds in your favor. I know that over the longer term, stocks have done a good job of outpacing inflation. I'm in my mid 40s. I got a good game plan. Great. I'm sticking to it.
So a lot of what we're talking about is the ability to diversify into different asset classes. You're talking about the impact of stocks. You showed how some subsets of stocks, whether it be small cap or value or large growth, how they have different returns over long periods of time, and then the impact of bonds as well. One of the asset classes that is on the tip of everybody's tongue, it seems like these days, is crypto. So talk to me a little bit about how Dimensional and advisors and investors around should be thinking about crypto in their portfolios.
Yeah, it's a great question. I mean, look, over the last couple of years, I feel like almost every single client event I'm on, I get that question, and we should, right? I mean, we want to pay attention to what's going on in financial markets. When you adopt this investment philosophy that we have here, it doesn't mean you're not paying attention to what's going on. You want to be well educated on that. And crypto is an interesting one because you have the underlying technology of blockchain, which, by the way, has incredible applications. I mean, there's plenty of companies that are already exploring how it can drive down the cost, increase efficiency, increase the speed of transactions with the underlying blockchain technology. I mean, here at Dimensional, we're looking at it. We have trading floors all over the world, and we're figuring out, are there ways that we could be more efficient with our trading by utilizing this technology? Okay, that is separate from Bitcoin or a cryptocurrency. That Bitcoin is just an output of blockchain technology, right? So make sure you understand, separate those two. Now, let's talk about crypto as an investment. It's gotten a lot of hype recently, and it should. There's a lot of money that's flowing into it. There's a lot of interest in there. The way that I think about crypto is really the way that I think about any type of investment. I believe this. I think with any investment that you're evaluating and you're considering putting in your portfolio, there's a couple basic questions you want to answer. And the first one is, and we've talked about this, what's the goal? I mean, why do I even own this asset to begin with, right? Stocks, what am I got? That's long-term growth, okay? Bonds, why do I own that? Well, it may be for capital preservation. It may be for income. If I'm tax sensitive, maybe I got some municipal bonds in there, but I can get real clear on the goal for that. For crypto, I'm not saying that you can't define what the goal is in the portfolio, but just get clear of why am I owning that? And that's for any investment, by the way. The second question you want to answer is what do I expect to earn on this? If I can't form some expectation for a return, it's really hard to build it into a financial plan because I just don't know what the outcome is going to be. Now, again, you're going to build sensitivity around that. And if you say stocks, I have an expected return of 10%, but I also know it could be 13 or it could be 7. Great. Build some buffers around there, but I've got a sense on what the expected return is. Your third question you want to answer is what's the associated risk with it? Any type of investment is going to have risk. We said that. That's why you get a return. There's uncertainty associated with it. Crypto is interesting because it's not just a volatility risk. It's been very volatile, and that's true. You have a security risk, although I think that is diminishing over time. You have a regulatory risk for sure. We don't know how this thing's going to actually shake out. And now you have a lot of central banks that are evaluating different cryptocurrencies and are they going to launch their own? Okay, well, that leads to a competition risk. There's hundreds of cryptocurrencies that are out there. Some of them probably will be the winner, but I can't tell you which one. Bitcoin's the biggest right now. Will it be the biggest 3 or 5 years from now? I don't know. There's going to be some winners. I'm not telling you that. I just don't know what it's going to be ahead of time. The fourth thing is cost, right? What's it cost you to get in? What's it cost you to get out? What are the taxes associated with that? Because by the way, when you're trading in and out of crypto, you got to pay short-term gains on that if you're not holding it for too long. And if you can answer all of those questions, why do I own it? What do I expect to earn? What's the associated risk? What's the cost of it? The last question is how much money should I put in it? And right now, if you look at all of the assets that are out there in the world, and it depends on how you cut it up, let's say cryptocurrencies are 1% of all of the investable assets that are out there. Okay, well, that's a good starting point. Is there some reason why I want to overweight relative to all of the other investors around the world? Would I want to underweight? And again, this is not to say don't go invest in cryptocurrencies. If it is to scratch an itch, or if it is that I believe I can answer all of those questions and I'm comfortable with the answers to them, great. But with any investment, systematically walk through those series of questions. And I think what you'll find is there's a lot of different, I'll say shiny objects over time that if you really reflected on it, you may not have had as solid of answers to those questions as you thought you did.
Just to reiterate, those 5 were what's the goal? What's the expected return? What's the risk? What's the cost? And then what % of your wealth should you be putting into that? Is that right?
Yeah, that's right. And I'll take stocks, right? You would say, okay, how much should I have in U.S. stocks, right? Well, U.S. makes up roughly 50% of the global stock market, right? I can answer the goal. I know the goal. I know the expected return. I know the risk that's associated with it. I know it's relatively inexpensive to get in and out of stock funds, right? So then how much would I want to invest? Well, I would look and say for U.S. stocks, 50% seems like a good starting point. Now, I may want to say, because I'm a U.S. investor, I want 60% or 70%, or maybe I feel strongly about emerging markets. I'm not here to tell you to make a bet on emerging markets or anything like that. But yeah, I think you answer those 5 questions and you get to a really comfortable spot before you put money to work.
So tell me then about that. Let's kind of go a little bit deeper on the U.S. versus international. This is something that over the last 10 years or so has been somewhat competitive in terms of where we're going to get additional returns and then what we've actually seen happen. Tell me why I shouldn't just put all of my stocks in the U.S. You told me maybe it's because 50% is already spread. But let me look at, again, what I often hear. Well, President Trump, President Biden, both of them had efforts to, build America, make America great again, to have American manufacturing. So why wouldn't I just say, oh, of course that's going to overperform over the next 10 years. Look how well it's done the last 10 years. Why wouldn't I just put more into U.S. stocks?
Yeah, it's kind of that, to an extent, it's sort of the chasing performance. Look, anytime anything's done well recently, people are going to ask, why shouldn't I put more into that? I don't care what the asset class is, U.S. stocks versus non-U.S. stocks. 10 years ago, we had a massive run up in gold. You literally can go down the line. And every time someone performs well, people say, why shouldn't I have put money into it? And I guess, look, at the highest level, here's the way I think about the global stock market is I want to buy global capitalism. I don't have a clue where the returns are going to come from. What I do know is that there's good companies and hardworking people and natural resources and good ideas. And you know what? They exist all around the world. And as an investor, my objective when I think about the stock market is to capture global capitalism in the most efficient manner possible. And look, let's take a look at an example here. So here's your, roughly, that's up to 57%. So it's a little bit higher, but it fluctuates from time to time there. But there's a huge opportunity that's out there, but I like to make it real. You think about something like car companies, right? I want to invest in the automotive industry. Do I just want to be invested in the U.S. automotive industry? Probably not. I like Germany. I like Italy, China, India, Japan, Korea. There's good car companies that are all over the world. And guess what? You know what their objective is? Their objective is to turn a profit and give some of that money back to shareholders. And as a shareholder, great. That sets up really, really well for me. Now, look, more recently, here's the reason that people are asking the question. This is back looking at 2019, but it's kind of continued. And you can see, look where the United States is. And that's why people are asking the question, why shouldn't I have had more money in the U.S. stock market? And by the way, you can always come up with a story on why you should, and whether it's the different policies that are coming about, or whether it's your political view, or whether you think that all these tech companies are located here. You can always come up with a story on why you should be invested more in the U.S. By the way, interestingly enough, I don't remember reading the article in 2010 that said put all of your money in New Zealand, but that actually would have been a better bet for you. But look, go back the decade before, and it's literally the exact opposite argument. I remember this. This was the lost decade, and this was back when, why do I have all of my money in the S&P? Why don't I have more in emerging value? I want more of those brick stocks that I'm hearing, or those brick countries that I'm hearing about. And so this is just such, in my opinion, a very time period specific argument. 10 years ago, investors would have been asking the exact opposite question. And 10 years from now, who knows? Maybe the U.S. is going to do great through the 2020s. I don't have a clue, but I don't really feel like taking a bet on that. Again, I want to own it all. I think there's great companies that sit all over the world. I have no clue what the future is going to hold. And I will always say I'm trying to capture those returns no matter where they're going to happen around the world. Just happen to be here in the U.S. And by the way, remember, in a diversified portfolio, you did capture those returns.
That's right. So go back, if you could, to the slide where it showed, there we go. So do you remember 10 years ago when everybody was talking about the BRIC and how Brazil, Russia, India, China, the returns that were coming out of there? It was unbelievable. And if you look at the last 10 years, there's an ETF that tracks the BRIC. It's down a cumulative 20%. But because if you look at this report, which shows Brazil is number 3 in the world, Russia is number 4, China is number 6, India, I think, maybe number 10 or so, 4 of the top 10, of course you would want to do that. That sounds amazing. But if you had put a tilted towards that, because that's how it's done well the last 10 years, you would be cumulative down 20% since then. If on the other hand, now, of course, like you said, everybody wants to be in the U.S. because I think the U.S. stock is up, a crazy amount in that same period of time. But who knows what the next 10 years will be? Isn't that the story?
Well, it's totally the story. And I know that those slides are really small there, so I apologize about that. But you got to fit a lot of countries on that slide. But you're right. I mean, look, it's kind of like your Rivian story or whatever it is. There's always a great narrative out there for why things have done well. It causes performance chasing, but investors that go down that path more often than not are probably disappointed with the outcome. Their returns probably don't conform to their expectations.
So tell me this, someone just sat on we've got a lot of people who have sat on for the last hour. Are we just saying do nothing? Like, I mean, where's the hope? Tell me about like how this is going to help me with my portfolio.
Well, it's not, you think, you go down to the trading floor here at Dimensional and they'll tell you, listen, one of the best trades you ever make is the one you don't make, right? And it's so hard as an investor just to accept that putting together a good game plan, working with an advisor, clearly articulating your goals and sticking to that gives you the best chance of success in every other aspect of life. The harder you work and the smarter you are and the more you dig, you're probably going to get ahead. It's not that way with investing. It just doesn't work that way. And why? Because you're competing with millions and hundreds of millions of people, billions of people that are playing the exact same game. And they're all trying to figure out this little edge that they can get and how can I predict this and find the signal and do all of that. And what the data tells you, I mean, you look at study after study after study, that it just never shakes out that way. Picking the stocks and timing the markets and trying to figure out this about inflation and doing this with interest rates, and they're going to go up and they're going to go down. And I know what countries are going to perform well. You look at the stats of professional money managers and they consistently underperform. So it's one of the hardest things to get over as an investor is that I don't have to do anything. All I need to do is get together with a good advisor, clearly articulate my goals, stick to the game plan. And then, as I like to say, go play golf or go on the boat or spend time with your kids or do whatever you want to do. Get involved with charities, get passionate about something, focus on these other areas of your life and kind of stop worrying about your money, because guess what? You hired a qualified professional to do that for you. And it's really liberating when you mentally kind of get over that hurdle and stop stressing out about this stuff.
It's a little bit like outsourcing your workout. Wouldn't that be pretty nice if we could just like hire somebody to do our working out for us, and then we can go out on a boat and not have to worry about, I didn't get my run in today. Someone else is doing it for you.
Yeah. Well, and also too, look, and I think about this, right? I mean, I think there's probably a lot of people on this call, speak for myself, a lot of my colleagues here, I'm sure Colin's like, we're hard workers. I care about my career. I know where I can add more value to my future every day. And guess what? It's with my human capital, right? I can put my financial capital to work and it can work for me, honestly, without having to do anything. And then I get to spend more time on accumulating more wealth through what I can do on my human capital side. So that's another part of it, is where's your biggest value add on a daily basis. And if you happen to still be in your working years, I truly believe that's how you can add more value. And that's how you can get to a better spot for retirement versus spending time stressing and tweaking your portfolio.
I love it. Jake, I certainly appreciate your time. I know that we did not get to everyone's questions. I was trying to watch, and I had some lists from before, so we tried to ping a couple of those in, and I really appreciate everyone for joining. Let me spend 2 minutes talking to two different groups of people. So for those of you who are Larson Financial clients, I want to thank you. I hope that you continue to enjoy these educational webinars and these opportunities with partners like Dimensional that we have. And really, as we try to bring you some thought leaders, I would love to hear what else would interest you. There are some things that we are working on, some additional stuff, whether it be conversations about target date funds or how to financially deal with divorce or tax-efficient retirement strategies. So if you're a client and you would find that interesting, or rather, even if you're not a client and you would find that interesting, please let us know. There's some feedback forms. You can go on larsonfinancial.com and do contact us. You can email me at president@larsonfinancial.com. If I can ever find a way to help you out as a client, I would love to be able to do that. Second of all, if you do have cash on the sidelines or questions from something that we talked about today, I would encourage you to reach out to your advisor. If you feel like you need to make some adjustments, you can go on, again, the website. You should have their emails or their contact information. You can book a meeting oftentimes at larsonfinancial.com. If you are not a Larson Financial client, I am guessing that there's something that you heard about tonight and you're like, oh my gosh, is my account being rebalanced? Am I properly diversified for the next downturn? Am I focusing on the wrong things? What was my inflation assessment, or what was the assumption being used for my retirement plans? Am I good on that? If you have questions on that sort of stuff, then please, you go to larsonfinancial.com right now, and you will see at the top of the website a banner that says, thank you for those of you who attended the webinar. You can click that and you can schedule some time directly from the conversations that we had tonight. We will know you are already interested in these things, and you will have some more information that you can reach out to about us, and you can actually book a time directly on our calendars. I can almost guarantee that there will be a time available to you because we have so many advisors around the nation and significant availability for whenever works for you, whether you're retired or whether you're still working. I'm sure we can find some time that works for you. Again, I thank all of you guys for coming. I would love to be able to continue to provide these for you. If there's more stuff that you want to know, please chime in, let us know. Thank you, Jake. Thank you, everybody else, and I hope that you have a great night.